Thank you everyone for joining us for our webinar today. In the interest of time and the amount of information we have to present, we're going to go ahead and get started as everyone continues to join us for the webinar today. We'd like to go through a few housekeeping items. All attendees are on mute. Therefore, if you have any questions, please utilize the questions feature in the far right screen of GoToWebinar. We are going to do our best to address questions at the end of each section. However, again, in the interest of time, we want to make sure that we have the opportunity to present as much information as possible during our 90-minute session today. We are recording the webinar and will circulate the recording after the event today. At this time, I'm going to go ahead and turn it over to Greg Horning.
Good afternoon, everyone. Thanks for joining us. We have a packed agenda today, so we're going to move right into it. Of course, anything we talk about today is general in nature, so I'm going to ask that before you act on anything here, you discuss with your tax advisor. So as we move on, I wanted to briefly touch on, many of you are likely aware that SC&H has put a significant effort into launching and sharing information as it becomes available. And on our website, the link is shown below. This resource center related to COVID-19 has scores of articles and blogs and content that should be helpful for many of you. We encourage you to keep an eye on content that's delivered through the site. On the next slide, we have the list of the illustrious speakers we have lined up for you today. We're going to kick off on the individual tax side, focus on some retirement planning items and estate and gift tax planning, led by Chris DeBlanc and Amanda Wilhelm. After their sections, Jim Wilhelm and his team, James Eaton, Steve Bishop, and Michael Dondi will be focused on business tax matters. So one of the things we talked about in putting this webinar together was, why are, and some of you may be thinking, we normally do these webinars on year-end tax planning in November. What makes 2020 unique that would cause us to do a mid-year session? And that's a number of factors. Every year we talk about I think the year being unique, but I think we can all agree that 2020 has started off, I guess we're in August already, but 2020 is extra unique. We've had not only the continued implementation of the Tax Cut and Jobs Act, but we've had in January the Secure Act that has significant implications on how we save for retirement. In March, we had the CARES Act that presents substantial opportunities for businesses and individuals, some of which have near-term impact and opportunities that can be taken advantage of right now, including some IRA moves that may need to be handled before August 31st. We have a low interest rate environment with potentially depressed asset values in people's portfolios and business interests that provide significant potential estate and gift planning opportunities. And on top of all that, we've got business tax changes, PPP loans. We've got state tax legislation that it likely could be significantly impactful for many of our clients. So to try to get ahead of all this planning that should be available for many clients, we thought that we'd get a head start on this now. So with that, we're going to jump right in. I'm going to turn it over to Chris DeBlanc, who's going to talk a little bit about the Secure Act and the CARES Act and the impact on individual planning around retirement. Go ahead, Chris.
Okay. All right. Good afternoon, everyone. My name is Chris DeBlanc. I'm a financial advisor with SC&H. Today we're going to be talking about the Secure Act, the CARES Act, and what they mean for your retirement. But before we jump into that, let's do our first polling question. So, about how much are the total unfunded liabilities owed by the United States? Is it 27 trillion, 56 trillion, 81 trillion, or 154 trillion? We'll give you about 30 seconds to select your answer and click submit. And for those of you that don't know, the unfunded liabilities include things like Social Security, Medicare's A, B, and D. Let's see what else. All federal debts held by the public, federal employee benefits, and veteran benefits. And I think that's probably enough time for everybody to get their answers in. So what do we have? Okay, can you go back so we can see the results? Well, the correct answer is 154 trillion, which is an exorbitant amount of money. So try to wrap your head around that number. Okay, moving on. All right, the Setting Every Community Up for Retirement Act of 2019, or the Secure Act, made 3 significant changes to the retirement landscape. First, the Secure Act eliminated what was referred to as the Stretch IRA. The Stretch IRA allowed beneficiaries of inherited IRAs to stretch their withdrawals over their lifetime. Now, this was a powerful tool for younger beneficiaries as it allowed the accounts to continue to grow over longer periods. But now, under the Secure Act, you have only 10 years to draw those accounts down 10 years after the original owner's death. Now, this is going to result in much larger distributions, and that may be nice for some people, but it's also going to result in a much higher taxable income that could push you potentially into a higher tax bracket. Now, this doesn't apply to spousal beneficiaries. The widowed spouse can still treat the IRA as their own. This also doesn't apply to minor children or disabled individuals. They can still choose to stretch the IRA over their own life expectancy. Now, note that the Secure Act became law on January 1 of 2020. So this doesn't impact inherited IRAs whose original owners died prior to January 1 of 2020. The second thing that the Secure Act changed was around IRA age limitations. So prior to the Secure Act, you couldn't make contributions to a traditional IRA after age 70 and a half. The Secure Act eliminated that prohibition. So now, as long as you have earned income, you can make a traditional IRA contribution. There's no age limit. All right, the next thing that the Secure Act changed for retirement pertained to required minimum distributions, or RMDs. Prior to the Secure Act, qualified retirement plan participants were required to begin taking RMDs at age 70 and a half. The Secure Act shifted that to age 72. And this affects recipients who attained age 70 and a half on or after January 1st of 2020. Those individuals will need to take their first RMDs beginning on April 1st of the year following their 72nd birthday. And the second RMD has to be taken by December 31st of the same year. So the first year you begin, you have to take 2 distributions. So those are some of the highlights of the Secure Act with respect to retirement. Now let's move on and look to the CARES Act. The Coronavirus Aid, Relief, and Economic Security Act, or the CARES Act, made several significant changes to retirement planning. First, the CARES Act suspended all RMDs for tax year 2020. So if you normally take distributions or you take normal RMDs, you don't have to take the money this year. You can leave it in the account, you can let it grow for another year and continue to defer the income taxes. If you already took your RMDs, you can put the money back. You can put it back into the same account you took it from, or you can roll it into another qualified account like a traditional IRA. Now, the CARES Act created 3 issues surrounding RMDs. The first issue was around the 60-day withdrawal rule. So under current tax law, and you can advance to the next slide, under the current tax law, IRA beneficiaries are allowed to withdraw funds from a qualified plan for up to 60 days without penalty. As long as you return the funds within 60 days, you pay no tax and no early withdrawal penalty. Now, the CARES Act was passed in March of 2020, and by that time, many people already took their RMDs and were outside that 60-day rollover window. So the CARES Act did extend that window out to July 15 for RMDs that were taken February 1st or later. However, it didn't apply to RMDs taken in January. Those distributions had no relief under the CARES Act. But the IRS stepped in And they fixed the issue with IRS Notice 2020-51. So you now have until August 31st to roll all previously distributed 2020 RMDs, and that includes distributions made in January. The next issue created by the CARES Act involved IRA rollover rules. Now, under the current tax law, you may only roll over one IRA distribution in a 12-month period, and RMDs are specifically prohibited from being rolled over. So for beneficiaries who already conducted one rollover in 2020, they're prohibited from subsequently rolling over their RMDs into another qualified account. Well, the CARES Act, again, provided no relief for taxpayers, but the IRS stepped in again with IRS Notice 2020-51, and they fixed this issue. So now all 2020 RMDs qualify to be rolled over, and rollovers or repayments of RMDs will not be treated as a rollover for the purpose of the 12-month rule. The third issue that the CARES Act created involved non-spousal beneficiary IRAs. Under the current tax law, non-spousal beneficiaries are prohibited from engaging in rollovers. So for non-spousal beneficiaries that had not yet taken their 2020 RMDs, the CARES Act eliminated the need for them to take them. However, if you already took your 2020 RMDs, the CARES Act, again, provided no relief for you to roll those funds back into a qualified account. The IRS, again, fixed this issue with IRS Notice 2020-51. So now 2020 RMDs from non-spousal beneficiary IRAs now qualify for rollovers. All right, well, that's enough about RMDs. Moving on, the next change that the CARES Act made to the retirement landscape was the creation of what's called the coronavirus-related distribution, or CRD. So if you were impacted by COVID-19, you have the ability to take a distribution of up to $100,000 from a qualified retirement account and not be subject to the 10% early withdrawal penalty. This applies to 401ks, 403bs, 457s, and IRAs. Next slide. To qualify, you must self-certify one of 5 different criteria. You have either been diagnosed with COVID-19 by an official CDC test, or you have a spouse or dependent that's been diagnosed with COVID-19. You've experienced adverse financial consequences as a result of being quarantined, being furloughed, laid off, or having work hours reduced due to COVID-19. You experienced adverse financial consequences as a result of being unable to work due to childcare or lack of childcare due to COVID-19. Or you experienced adverse financial consequences as a result of closing or reducing hours of a business that you either own, like you own stock in a company and that company's stock went down, you've been adversely you've had some adverse financial consequences because of that, or you operate a business that had to close or reduce its hours. So if you meet one of those 5 requirements, and I think many of you probably do, you qualify to make a coronavirus-related distribution from your qualified retirement account. So you have great flexibility when it comes to how the CRD is taxed. You essentially have 3 options. Option 1 is that you can include the entire distribution in your 2020 taxable income and pay all the tax now. Now, that's probably not the best option, as it may kick you into a higher tax bracket and you end up paying more taxes than you otherwise would. Option 2, you're allowed to make an election to spread that CRD income over the next 3 years. So 1/3 will get included in 2020's taxable income, 1/3 will get included in 2021's taxable income, and 1/3 gets included in 2022's taxable income. This option allows you to take the money now and spread that tax hit over the next 3 years. It may also enable you to reduce your overall tax liability by keeping you in a lower tax bracket. Option 3, if you opted to spread that income over the 3 years, you also have the option to repay the entire distribution in year 3. Now, the repayment is treated as if it were repaid in 2020, so you wouldn't be subject to any taxes or penalties. However, you do need to include the distributions and taxable incomes for years 2020 and 2021. So you need to file amended tax returns for those years to claim a refund for the taxes already paid. All right, so that's the coronavirus-related distribution. Now, the CARES Act also made a few notable changes to workplace retirement plans. The first change increased the maximum amount a plan participant can borrow from the plan. So if you need to take a loan from, say, your 401k, you can now borrow the lesser of $100,000 or 100% of the account balance. Now, this is an increase from $50,000 or 50%, so they doubled the amount that you can borrow. Second, they delayed the 2020 repayments for up to a year, so you now have extra time to pay the money back. However, the interest on that outstanding loan will continue to accrue. The third thing that changed was the suspension of the mandatory 20% withholding tax that applies to early distributions from workplace retirement plans. So if you were to take an early distribution from your 401k of $100,000, you would net $100,000. You're not 80. However, you'd still owe the tax on that money, so don't spend it all without having a plan for how to pay the taxes in the future. All right, so next slide. Those are some of the key changes that the Secure Act and the CARES Act have made to the retirement landscape. Now let's talk about some planning strategies that you can implement to capitalize on these changes. So number one, if you don't need your RMDs, don't take them. You can let them sit for another year. This may give you some time to let your investments rebound from the market lows. This will also reduce your 2020 taxable income and the subsequent tax liability. Number two is to convert your RMDs from tax deferred to tax free with a Roth conversion. So rather than take your IRA distribution, consider converting it to a Roth IRA. You pay the tax on it now, and then you let it grow inside the Roth tax free. So this will avoid future taxes, and since Roth IRAs aren't subject to RMD rules, it'll avoid future RMDs. Now, that may not make sense if you're in a higher tax bracket, like 32, 35, or 37%, but for many of you, it makes sense to at least fill up that 24% tax bracket. So convert as much as you can to fill that bracket up. Number three is to take the IRA distribution now and pay the tax over the next 3 years. If you're a qualified individual as defined by the CARES Act, and you already plan on taking an IRA distribution, you can turn that normal IRA distribution into a coronavirus-related distribution, spread the income tax hit over the next 3 years. You can potentially lower your tax bracket and pay less in total tax. Number four, for taxable accounts, consider doing some tax loss harvesting. Sell your losers now, take the capital losses this year. You can deduct up to $3,000 of capital losses after offsetting capital gains. This can also help to offset some of the taxable income created by, say, a Roth conversion. Just make sure that you execute this in a way that aligns with both your investment strategy and doesn't run afoul of the IRS's wash loss rules. Now, I have a fifth point that isn't on the slides, but I wanted to mention it. This is not to get political. 2020 is an election year, and in today's day and age, the tax code is a political weapon. So I think that if Donald Trump gets reelected, we can probably enjoy another 4 years of lower taxes created by the Tax Cuts and Jobs Act of 2017. If Joe Biden gets elected, I think many of you may expect a higher tax bill, as he's already promised to raise taxes for businesses and quote unquote wealthy individuals. Biden's proposals includes eliminating the lower tax rates on capital gains, increasing tax rates to 39% on families who make over $400,000 per year, and eliminating the ability to expense depreciation. So if this happens, it could mean that rather than taking capital losses this year, maybe we want to take capital gains and defer those losses to the future. Or if your projected tax rate is going to go from 32 to 39%, maybe it makes sense to accelerate ordinary income into 2020 in order to maximize that permanent tax difference. Now, again, these are just proposals, but if Biden does get elected and the tax pendulum is set to swing to higher taxes, you may need to make some tough decisions this year as we approach year end. And if that happens, give us a call. We can help you through it. That's what we're here for. And that's all I have. Thank you for your time. And now I'm going to pass it off to Amanda.
Chris, thank you very much. And thank you all again for joining us today. We really appreciate it. So I struggled a bit with the title of my part of the presentation when thinking about our current circumstances. All we seem to hear about these days are, failing businesses, the stock market being a roller coaster, a huge national debt. So it's hard to imagine opportunity in the middle of this chaos, but there is definitely some lemonade to be made from these lemons we've been given. So what are we talking about here? So as I've outlined in my slides, the opportunity lies in a really unique combination. You have businesses who have decreased asset values, but have a high probability of a strong rebound, crazy low federal interest rates, and historically large but possibly short-lived estate and gift tax exemptions. So if you mix all this together, it provides a really unique climate and thus an opportunity for estate and gift tax planning. There's also the opportunity for some charitable planning as well. So before we dive into our discussion on these planning vehicles, let me provide a quick outline of where we are with the current estate and gift tax regime. So quick summary, we still have a federal estate and gift tax regime in place. Some states, including Maryland, have their own estate tax as well, but we'll be focusing on federal for now due to the interest of time. In 2018, we had tax reform, and part of that was a very large increase to what is called the lifetime exemption. The federal estate tax exemption doubled to about $10 million per person, which has been increased for inflation each year since then. For 2020, the exemption allows individuals to transfer up to about $11.58 million by either lifetime gift, transfer at death, or a combination of the two without paying estate or gift taxes. For a married couple, that is $23.16 million. This exemption is by far the most favorable in recent memory. Just for some perspective, in 2000, the year 2000, the exemption was a mere $675,000. The top rate was 55% for estate and gift. Right now, the tax rate for the gift and estate tax rate, that if we exceed that exemption amount I talked about, the top tax rate is 40%. So it's definitely a difference. You may be thinking, okay, Amanda, I get it. I need to consider these friendlier tax laws in place now, but we have a few years before they go away. You know, they're not set to expire till, 2025 when the TCJA expires. Well, not necessarily. As Chris already noted, we have a presidential election coming up this fall, and change of administration typically results in an impact on tax rates. Again, not being political, Mr. Biden, he's already been making comments about the repeal of tax reform, and one of the easiest parts of that to go after is the favorable gift and estate tax exemption. On the flip side of that, you can look at it regardless of who wins the White House. They may be forced to raise rates and dismantle a good bit of the TCJA because, we might need, we're going to need the money. You pile a couple of $1 trillion stimulus packages on top of an already staggering national debt, you could end up backed into a corner, and it's pretty easy just to raise the money by raising taxes. So let's go to our next slide. So I wanted to provide everyone with a summary of where federal interest rates are at this time. In August, for August 2020, these were just published. Just to provide some perspective, I listed the rate chart for August 2019 along the rates for August 2020 to show just how low rates are at this time. The midterm rate, which is the most common rate used, is a 3 to 9 year loans. We're at an annual rate of 0.41%. Last year at this time, it was 1.87%. That's a big spread when you're considering a transfer of a large amount of value. So, while our money market accounts and other interest-bearing investments are crying the blues, these low interest rates, they scream opportunity when we start to consider GRAT transfers, loans to trust, charitable planning, all tools to consider when transferring wealth to the next generation. So let's take a look at our next slide. Some opportunities to consider here. What are some of these groovy opportunities? Well, first, let's talk about alternate valuation. So what are we talking about here? This is a post-mortem planning tool, but in a nutshell, when an individual passes away, to determine if you're going to be impacted by the estate tax, you essentially compile a balance sheet as of their date of death. In general, it's gross assets less liabilities. It equals your net taxable estate. You apply that $11.5 million exemption we were talking about, and whatever's left over, you pay 40% on that remainder. The value assigned to the assets is as of date of death, but you also have a choice to use an alternate date, which is 6 months after the date of death. So for 2020, what we should consider is, do we use date of death value or do we consider the alternate date? So let's say a decedent passes away in early January of 2020. At that time, the market was still good. The economy overall was still good. You would expect asset values in January to be fairly strong, but looking out 6 months out to July, and it's probably not the same story. In this case, we'd look to use the July values because we'd be reporting lower asset value on the estate tax return and reducing the estate tax bill. You might say, well, that's a big exemption you talked about earlier. That kind of takes care of me for federal, so no worries. true, but if you're a Maryland resident or, a resident of a state that has a state tax, you're dealing with a state level estate tax with an exemption for Maryland. It's only $5 million. So this little tip could possibly save some Maryland estate tax. Next up is outright gifts. Yes, it's as simple as it sounds, and it has its place in many estate plans. Be sure to consider making annual outright gifts to family and friends to take advantage of that annual exclusion we all have. Each taxpayer, we can give up to $15,000 to any unlimited number of individuals each year and not pay $1 of gift tax. Parents, grandparents, if you're helping out with the kids or grandkids' education, private school, college, or if unfortunately you're assisting with medical bills, write those checks directly to the school or medical facility. When you do that, they're not considered gifts because you're paying them directly to the institution. So you're not using your annual exclusion or lifetime exemption. Again, given depressed asset values and a hefty exemption, direct gifts of a larger amount could make sense too. Of course, with all of those tips we're discussing, none of these are a one-size-fits-all plan. So we definitely discuss that with your advisor before pulling the trigger on any of these. So let's jump to the next slide and we'll talk about some trust. Now, the trusts I have noted here, they're not the end-all be-all, and I won't be getting into the technical weeds too much on these, but the ones that we have listed here, I believe, are the top ones to be considering in this current environment. Her perfect storm combination that we discussed at the beginning of this section, it packs the most punch when utilized through these trusts. So what do we mean by that? As I outlined, the gift tax bite is based on a percentage of the current value of the assets you're transferring. So these transfers made during a time of depressed values, combined with legitimate discounts for lack of control, lack of marketability, et cetera, it creates a much lower tax cost than what it's likely going to be after the economy recovers. Excuse me. So let's talk first about an IDGET, and that is an intentionally defective grantor trust. When an individual creates an irrevocable IDGET and transfers assets to it, that individual ceases to be the owner of those assets, but they continue to be responsible for any income tax owed by the trust. So by doing this, a transfer to the IDGET removes the property from the grantor's taxable estate for federal estate tax purposes. Now, the transfer is a gift for federal gift tax purposes, which will be reported on a gift tax return, and it uses a portion of that large exemption we've been talking about. But the cool thing is no gift tax would be owed if the exemption is larger than the value of the property that you gifted. And transferring those assets at currently lower values allows for more asset growth to occur within the trust and outside of your taxable estate. So at the current estate tax rates, you're potentially saving 40 cents of estate tax on every dollar of growth, and even more savings if the estate tax rate goes up. You might say, but I'm still paying the income tax for the trust. Right, but the advantage here is if you're further reducing the value of your taxable estate by continuing to pay the income tax for that trust, you're allowing those assets to remain in the trust and grow tax-free, and it's still a win-win and very powerful. Another item to consider, sale to an IDGET. So what do I mean by this? So a simple explanation, you sell assets at their currently low fair market value to the IDGET, and in exchange for that, you get an interest-only note, and that note has a balloon payment due after a certain period of time. The trust can then use the income from the assets transferred to make payments on the note, payments back to you. The sale doesn't utilize any of your lifetime exemption as you aren't making a gift. You're merely swapping an asset for a note of the same value. You may say, well, wait a minute, what did I accomplish here? Because my estate value is the same. I just swapped my stock for a note. Right, but the master plan is when the promissory note balloons, the assets that you transferred will have grown in value, exceeding the note's interest rate, which is ranging from 0.17% to 1.1% roughly for August of 2020. Any asset growth that exceeds the note's interest rate could save you roughly, again, 40 cents of estate tax on every dollar of growth. So it's something, again, that could be very powerful. So now on to GRATs. Many of us have probably heard this term, grantor retained annuity trust. In my humble opinion, GRATs probably hold the most planning appeal in this current environment. Why is that? Do you say grants are very effective when you're looking to move low basis, low value assets that you believe are going to blow up in value over the next few years, and you get them out of your estate. If you're using little to none of your gift tax exemption, and we'll talk about how to do that, now you're gambling against the odds of outliving the term of the GRAT and values continuing to rise. But right now in the current climate, the odds are looking pretty good for taxpayers. So how does this work? How this works is you transfer assets to a GRAT, and in turn, you receive the right to annuity payments from the trust for its entire term, which can't be less than a 2-year term, keep in mind. The interest rates to calculate that annuity payment to you is based on the current AFR, those rates that we were just talking about, the federal rates, which we, again, all know are very low right now. And it's just really another piece of this perfect combination and planning. Once the trust term is up, the asset you contributed plus the appreciated value have all moved to your children and out of your estate. That's the definition of a successful GRAT. So what are we talking when we talk about the gift tax implications here? So as I mentioned, it can be little to nothing. The value of the gift that you're making is what we call the remainder interest, or what you calculate to be remaining of your initial gift at the end of the trust after you've been paid your annuity. If you set your annuity payment, if you set it to be exactly equal to the AFR, which means that of the assets that you've transferred into the GRAT, they will just theoretically be returned to you via the annuity payment, and nothing would be left over for your children at the end of the term, then you would have used 0 gift tax exemption to move all of that appreciated value out of your estate. Doing that, all it cost you were professional fees to set up everything, file a gift tax return, do valuations. This technique we're talking about, that's what we are referred to as a zeroed out GRAT, but again, can be very, very effective. Let's go to our next slide. So let's talk about some charitable planning. A charitable trust incorporates strategies from the GRAT that we just talked about, but it also allows for charitable planning and some potential income tax savings for the grantor. There's a few flavors of this trust too. We have a charitable lead, charitable remainder, unit trust, annuity. They all hinge on whether you wish for the charity to receive funds during your lifetime or if they receive the gift upon your death. So a charitable lead trust, this type of trust allows you to give assets to a charity now, which is cool. You actually are alive to get to see the benefit of your contribution. But it also allows you to leave assets to your family upon your death. So you get to accomplish 2 things there. Again, the gift tax exemption you are using here when we talk about a charitable lead trust is that remainder interest, what is calculated to be left over from the initial gift after the charity has been paid. So this could be a very low amount. And again, using assets that are expected to spike in value is the trick as you're moving the asset and appreciation out of your estate. From an income tax perspective, once you contribute the assets to the trust, you're entitled now to a charitable deduction on your personal income tax return that's equal to the present value of those future payments that are going to be made to the charity. So think about this not only from an estate planning perspective, but think about it in a year when you have a large income tax liability. That charitable deduction could be very useful. A charitable remainder trust is somewhat of the opposite. In that case, you receive the payments or annuity during your lifetime, and upon your passing, the remainder goes to the charity. Now, with a CRT, you pay no gift tax, which is a bonus, and on top of that, you receive an immediate charitable deduction for the remainder value, what you think is going to be left over, that is going to the charity. You get a current deduction for that. So again, a CLT, it's a great tool, in my opinion, to consider in a high tax year, a low interest rate environment when you want to combine estate planning and charitable giving. You may say, I like this idea, but I have no idea what charity to tap. What if I don't want to designate just one charity? What if I change my mind? Well, then we can think about you could have your family foundation. You have a private foundation set up, or even better and more efficient, a donor advised fund. Have them be the charitable recipient. This gives you some flexibility and additional say and a chance to change your mind on where you want those charitable funds to go. I know I've thrown a lot of information at you, and I we truly hope it was informative. Our advisory and tax team, we've already been working with these existing clients on this strategy, and SC&H, our valuation group, they have been busy and will continue to be busy this year knocking out these valuations. But keep them in mind if you decide to move forward with any of these ideas. So that gives us our our second polling question. True or false, the current federal estate and gift tax exemption amounts are set to expire at the end of 2025. And I believe we have the answers in. If you said true, you got that right. You were paying attention. Thanks so much. So I believe I'm going to check in to see if we have any outstanding questions before we head into our business tax planning top side of the house.
So thanks, Amanda, for that, and Chris. In the interest of moving forward with the rest of the content, we don't have anything at the moment that needs to be addressed. So I'm going to move on with, I think Jim Wilhelm's going to make some initial comments as we jump into the business tax planning section of the presentation.
Thanks, Greg, and thanks, Chris and Amanda and everyone for joining us today, and the rest of my colleagues who will be speaking after I do. And I hope that everyone continues to stay well in 2020. So I'm going to kick it off on the business tax side and talk about two topics. The first is the Maryland pass-through entity election. So the General Assembly of Maryland passed this taxpayer-friendly legislation. And yes, I just said all of those words in the same sentence. This past session, way back as COVID-19 was really starting to swarm the US. And this legislation will allow partnerships and S corporations that file Maryland returns to make an election to treat the Maryland tax that is due on business income as an obligation of the entity as opposed to an obligation of the owners. Typically, pass-through entity income eventually makes its way to the owner's individual returns, and they are responsible for the tax. The goal of this legislation is a somewhat clever workaround to the SALT limitation that was imposed on business owners and everyone really from the Tax Cuts and Jobs Acts of 2017, where state taxes, the overall deduction was limited to $10,000. So if you have business income of $500,000 on your return and you owe Maryland $40,000, you could only deduct $10,000 of that. The other $30,000 disappeared in terms of a deduction. So a number of states have tried to put some workarounds together. Early on, a lot of them were beat down by the IRS. And this is one of the workarounds that several other states have employed, and Maryland has now followed suit. So it's actually good law, one of the few bright spots of 2020. So the effect of this election on a net basis would be to reduce the federal tax, because that's where we're getting the deduction at the federal level, of affected business owners by 2.5% to 3.3% of the taxable income from the business. So it's probably not going to let anyone retire early, but it still should be meaningful and something that you look at. The election is for 2020. We do not yet know when, where, or how to make the election. It was effective for calendar year 2020. The law itself came in place July 1st, so it's still pretty new. And we're waiting for the comptroller to give us the details on mechanics. Some things to think about here. This would impact tax distributions made probably in the second half of 2020 from pass-through entities. Usually pass-through businesses will make distributions to owners throughout the year so that they can pay the federal and state taxes due on business income. If you make this election, again, once we know how to do it, the business should then should reduce their normal tax distribution by the amount it will pay directly to Maryland on behalf of its owners. So there'll have to be a little extra math when we look at third quarter estimates. In September, it also may end up being that business owners who have already paid their first and second quarter estimates, which were due this year, July 15th. And again, if you make the election and the business will now owe the tax on that income, you'll find that the owner will, all else being equal, be overpaid for 2020. And so you'll need to make some adjustments to maybe fourth quarter withholding and estimates they would otherwise have made personally. Some of the details here, income allocated by a pass-through entity to tax-exempt entities and qualified plans like an IRA would not be taxed under this election. So even if the business elects to have all of its income in Maryland taxed at the business level, if the owner would otherwise have not paid tax, there'll be an adjustment for that. One thing that isn't clear yet is how C corporation partners in a partnership would be impacted, since C corp partners already get to deduct their state taxes, unlike individuals. Pass-through entities that own another pass-through entity will need to make their own election at the higher, the second tier or the upper tier level. So their share of business income, you cannot make the election on their behalf, or it won't. Their allocation will not be impacted by that election. This election will not be beneficial to pass-through entities that only have investment income. It's really got to be trade or business income, rental income. Double taxation is avoided mechanically because the pass-through owner, who will get a K-1 that says, here is your Maryland K-1, please put this amount of income on your Maryland return, they will then get a credit on their individual return for the income tax that's already been paid at the pass-through entity level. So complicates the individual return a little bit at the Maryland level, but you avoid double tax, obviously. Pass-through entity owners who, once they make this election, may still owe a little bit of Maryland tax on business income, because the way the math is going to work, the local tax rate used in the calculation will be the lowest tax rate that's out there right now. So if you're in a county or Baltimore City where the rate is higher than most jurisdictions, you would still have a little piece of state tax that you would have to pay beyond what's been paid at the entity level. Open questions, again, mechanics, timing, form, where do we make it, how do we make it, to whom do we send it? Is it an annual election or is it a forever election? If you make it forever, how do you rescind it or revoke it in the future? How do we handle first and second quarter estimates that have already been paid? Probably not too complicated, but we'll need to think through that. And then what about a pass-through entity that has operating income and investment income? Obviously, some of the state tax incurred on that would be trade or business income that would benefit from the election, but some of it would not. Again, Maryland's going to need to give us some guidance, which ideally we would get before September 15th. My next topic is going to be PPP forgiveness and related deductibility of those expenses. It would not be an SC&H webinar if I was not talking about PPP, the Paycheck Protection Program. The CARES Act created PPP loans, which not only created cash availability for millions of businesses, it also afforded them the chance to have this loan forgiven if the funds were spent in a certain manner within a certain time frame. And anyone who's attended our webinars or read our blogs on this knows we have an 8-week period and now a 24-week period, and a bunch of rules we need to follow as to how we spend the money to achieve maximum or even total forgiveness. One of the nice things about the act was that Congress specifically put into the CARES Act that the forgiveness of the loan would not be taxable to the borrower. Normally, if an individual or a business has cancellation of debt income, they also will soon get a tax bill with a few exclusions. Here, Congress thought that they did not want businesses to have a tax burden, related to loan forgiveness. The IRS issued guidance in late April that said while loan forgiveness is non-taxable under the CARES Act, IRS Code Section 265 would require that expenses related to this now tax-exempt income would not be deductible. And I think if you look at the law, it's the correct answer. But if you only look at the law, arguments that are being made by commentators around the country, outside of Congress and inside of Congress, are that congressional intent was that the forgiveness of the loan was to not create a tax obligation for the borrower. So while the loan forgiveness is non-taxable, disallowing the deductions for the expenses gets you right back to where you would have been had you made the loan forgiveness taxable. So they're arguing that that was not the intent of Congress, and the only way to cure that is for Congress to pass a law or change the law and fix that. That law was proposed a couple of months ago. It sat around. I believe it died. And now Congress is once again looking at COVID-19 relief. And in the GOP proposal, they had PPP related expenses once again being deductible. So we hope and think that Congress will act. Sooner would be better than later, so we can plan. And once again, those expenses will be deductible. So if they do not fix it, and the IRS has already said how they're going to treat it, what do we need to think about? Right now, a lot of companies have a PPP loan sitting on their balance sheet as debt. If this becomes income by the end of the year, it's going to create a nasty surprise for a lot of companies. So one idea might be to book that into income now, just so that it reminds you, while my net operating income is X right now, once this loan is forgiven, it's going to be a lot higher, again, under the current rules. From a timing perspective, here's an interesting question. Again, if expenses remain non-deductible, well, when do we disallow the deductions? Is it when the company books the loan as being forgiven? Is it when the bank approves forgiveness? Or is it when the SBA approves? Don't know the answers to that yet. And again, hopefully we don't need to know the answers to that because Congress will fix it. But that could change the impact of losing the deductions from 2020 to maybe 2021. Maybe it's further. For loans over $2 million, you have an automatic SBA review coming your way. There are 30,000 such loans across the country. How long will it take the SBA to get through all of that is anyone's guess. So timing will be an interesting issue if this issue exists still. Other questions would be, what if some of the expenses that were related to your PPP loan were already deducted in 2019? How do we handle that? Examples could be an accrued retirement plan contribution, accrued interest, accrued rent, accrued utility expense. You deducted it in 19 already, you filed that return, we've all moved on, but now we find out it wasn't deductible. Are we amending returns? Are we picking it up in 2020? We don't know. What if you had to capitalize some of these expenses? Again, we could go down the rabbit hole, and I hope that we don't have to do that. And then one little tricky thing to think about perhaps is if Congress does act and loan forgiveness is not taxable and all the expenses remain deductible as they otherwise would have been, would states like Maryland decouple from this treatment in an effort to increase state income and therefore state revenues? I could see that as a possibility. They could easily decouple from the one provision of the CARES Act that says loan forgiveness is not taxable. So we'll need to pay attention to this, not just at the federal level, but at the state level. And that is it for my 2 slides. I think we have a polling question coming up. Okay, Maryland's new pass-through entity tax election is effective for 2020, 2019, 2021, or 1999. We'll give you 30 seconds to answer that. And while you're clicking the box, hopefully getting it correct, I can introduce James Eaton, who is going to dive into the meat of business tax planning in 2020, which is going to be, I think it's a 5-month process, given all the things that are in play. And then we'll hear from Steve Bishop and Michael Bonney as well.
Super.
And 89% of you got it right, so thank you. It's effective for 2020. And again, stay tuned for us to give you more details on when that election can be made and how it can be made. James?
Super, thanks, Jim. Great, so as Jim has outlined, there's a lot going on, but let's take a step back and let's think about maybe some of our traditional standard annual tax planning kind of concepts. And let's say, okay, given all that we know that has changed or is changing, do our standard rules still apply? Can we still kind of look at basic year-end blocking and tackling tax planning? And then what implications or what other kind of ideas can we come up with that are new for the 2020 tax year? So something we've talked about for years and years is cash versus accrual tax planning. So many business owners are familiar with this, and some of you are pulling out your hair, right? Just hearing these words and saying, hey, I've got my financials and I look at those on a monthly basis, and then at the end of the year, you know, we do some sort of magic and I get a different number for taxes. That's an important sort of consideration when we look at this. The idea between using the accrual basis of accounting for our book economic reporting and cash basis is for tax is that using a cash basis of accounting allows our tax payments to move in tandem with our collections. That is to say, if we have funds that we haven't received by the end of the year, then we don't have to pay taxes on those. And that's the general concept. That works out great. It's very useful. However, in years like 2020, where there's so much going on, we have to be thoughtful about that. So normally for many years, we might say, hey, as you approach the fourth quarter of the year, let's look at what expenses we can accelerate into the end of 2020 so that we can bring 2020's taxable income down. And that's a great idea. Sometimes folks will look at that and they'll say we've identified a certain number of expenditures, and we're going to go ahead and access our liquidity or a line of credit at the bank, and we'll go ahead and pick out X, right? $100,000 or $200,000 of expenses that we can pay for late in 2020. That will be prepaid at the end of the year, but we get a deduction. We accelerate the deduction into 2020. Great. That all works in a year where the bank is very happy, liquidity is flush. We either got cash flow or we've got plenty of room on our line of credit. Those are items that might not be the case for every business here in 2020. We also may have covenant issues for someone who takes out, as Jim talked about, PPP loans. Is it possible that the bank is going to look at those as loans and say, hey, you can't take out more debt or else you're going to be on the wrong side of your covenant? These are the type of sort of broader and longer term issues we need to think about. So if part of your normal year-end planning was, hey, James, thanks, I know we're supposed to pay our January utility bills or whatever bills we can in December, that probably still makes sense. But the question is, let's just think ahead and make sure that's not going to cause us more trouble from the bank side or from a cash flow perspective. Another thought process here is to say, let's take it up a level and let's think about that and say, does the standard concept of driving down our taxable income in 2020 actually make sense? If you're in a business where 2020 is not a great year, you know, we're getting by, but maybe we're not going to have a great year, then does it make sense to decrease our taxable income down to zero, or maybe even decrease it to a negative number? Or might it make sense to kind of hold off on generating those excess or additional cash basis deductions in 2020? So some folks may be in a scenario where you look at an income leveling approach. And so we've got a couple of examples here, super basic examples, but let's just take a look at them. Let's just say that you use your standard kind of cash basis thought process, and we accelerate some deductions into 2020. And that drives taxable income for the owner down to $200,000 just for fun. Well, let's just say then that we have an average tax rate of 19%. Great. Now in 2021, the world comes back closer to normal, things are better, and taxable income is actually $400,000, and a lot of that is in a 24% tax bracket. So when we average these 2 years out, we actually end up with an average tax rate of 22.6. Let's just round it to 23%, right? Okay, fine. Is that good or bad? I don't know, but that's what it is. Let's say we took the same scenario and we had an alternate universe and we knew all these things ahead of time and we could look at them and we said, hey, rather than paying additional expenses at the end of 2020, what if we don't do that? Goodness, James, that's going to bring my 2020 taxable income up. That's probably true. But in a scenario like that, if we assume that you're going to have the same $600,000 of taxable income combined between 2020 and 2021, you might actually find that both years stay in the lower tax bracket. So in this example number 2, we'll have $300,000 of taxable income in 2020 and 2021. Average tax rate then is 20% over the entire 2-year period, and you're actually saving roughly 2.5, 2 3/4, maybe 3% taxes over the 2 years. Great. What does that mean? 3% of $600,000 of income is $18,000 of taxes. It's not something that we're going to buy a vacation home, but saving $18,000 in taxes is still saving $18,000 in taxes. So these are the sort of scenarios where we say we have to think about that. Maybe as we discussed a few minutes ago, we might also consider, hey, is it logical to assume that tax rates are going to be the same in 2021 as 2020, right, with elections and things like that? Maybe we'll have more clarity on that as we approach the end of the year. So these are all the types of things, just as Jim outlined, which are, gosh, we don't know all of these, so we need to kind of set up a series of different structures that we might use, kind of come up with a menu of different options we might use, and then be prepared to look at what actually occurs throughout the year. Similarly, many businesses come to the end of the year and they say, hey, let's make a use of asset expensing and accelerated depreciation options, what we've gotten used to of calling Section 179 deductions and making use of bonus depreciation. It's possible that if 2020 was just a break-even year, it might actually make sense to either hold off on making those year-end acquisitions of additional equipment, or maybe not take the bonus depreciation and let that flow forward onto the 2020 and later tax returns. Now, we can make the decision about how to represent the depreciation and the Section 179 deduction on the tax returns, but the acquisitions basically have to be done have to be reported in the year in which they occur. So if you're a client that Steve Bishop and I work on, and you buy a couple of trucks every year, right, large Ford F-350 kind of trucks for $100,000 a piece, and you say, hey, 2020 is going to be a break-even year, maybe you call the dealer and say, hey, I'll take delivery and I'll buy those trucks in 2021 rather than 2020, so that we can push the deduction out of the 2020 year and into the 2021 year. So we have to look at both sides of this. Should we accelerate deductions? Should we decrease revenues? Or should we push that out? And that's going to vary for every business and every different scenario. So what else can we look at for opportunities? We can look at some of the standard sort of things that we look at periodically, which is entity structuring. If I'm a single member, or if I'm a partnership, if I'm a single member LLC, or if I'm a partnership, might it make sense in today's world to convert to an S corporation? We maintain only having a single level of taxation, so we don't have corporate level taxation and the owner being taxed. We may be able to mitigate some self-employment tax or payroll tax consequences for owners that are having a lot of ordinary income in a partnership. Maybe we can limit some of the Medicare taxation. And we can also take advantage for some taxpayers between the PPP and the qualified business income deduction. We can manage those things and say, hey, if I was a single member LLC, I would have been eligible for PPP loan. but I wouldn't be getting my owner's compensation included in the qualified business income deduction. If I convert to an S corporation, then the owner can take a paycheck. That still counts as payroll for PPP purposes, and it also counts as payroll for the qualified business income deduction. So we may be able to come up with some strategies to maximize tax benefits that were started in tax year 2018 with the TCJA. Another thing that we've been getting a fair number of questions about are changes in accounting method, that accrual versus cash. A couple of years ago with TCJA, that overall method of accounting, the limit was raised from businesses with average gross receipts of 10 million, that was raised to 25 million. So that allowed a lot more businesses to make use of this concept. But now that we're looking forward and we're looking at a 2020 year that for some businesses isn't great, and we say, wow, does it make sense to convert to cash, or does it make sense to convert back to an accrual basis if we converted to cash a few years ago? There's a couple of things to consider there. It's great if you have a negative consequence because of, let's say, accounts receivable go down in the 2020 year because it's not a great year. It might be the right year to convert over, because if you find that you're having a negative consequence, a negative adjustment for the change in accounting method, a change that's not beneficial to the taxpayer, you can actually spread that income out over several years. Again, we'll refer back to the folks that were talking earlier about timing of income. That's a really interesting concept. Does it make sense to defer income in the current tax structure and then pick up income later on when tax rates may be higher? That's a really tricky analysis, and we'll know more later in the year. An important thing to remember is that this type of change in accounting method can only be used once every 5 years. So if you just converted from accrual to cash 2 years ago, you won't be able to convert back in the 2020 tax year. So that's something to consider. Also, if you say, hey, this is a year that I want to convert, you're stuck with that method for 5 years. So it may not be beneficial in future years. And that's a really important consideration to look a little bit longer term as well. So these are opportunities. What kind of pitfalls, what kind of things do we need to be aware of? Again, when we look at accounting methods, oftentimes we say, hey, this is great. The cash method allows me to defer paying tax on income that I've booked onto my books, but for which I haven't received the cash. That's great. We align our tax hit with our cash receipts. That makes sense. Unfortunately, in years like 2020, and we've seen this, maybe in 2012, maybe in 2008, we saw this sort of whipsaw effect where we say, okay, great, the cash method is really helps me when I don't have to pay tax on my accounts receivable. But if the 2020 year end is not great and we have lower accounts receivable, then we may actually have a net positive adjustment year over year. What does all that mean? It means if you take your books and you're used to saying, hey, my books say I have a profit of 100, but after I adjust for my accounts receivable and my accounts payable, I actually only have taxable income of 90. So it's a $10 beneficial change. In a year like 2020 where AR might be down, business activity might be down, you might actually say, hey, my books have a profit of 100, and for tax return purposes, I'm going to have a profit of 110. I'm actually going to have what feels like phantom income that I've deferred into the 2020 year. It's really important to keep track of that and to not only look at financial reports, but also kind of try to rough up what the tax P&L would look like. It is possible, and we have seen over the years, folks that say, hey, I'm at break even, or I have a loss and I won't need to be paying any taxes, so let's hold off on paying taxes quarterly. And when we come to the end of the year, because of the vagaries of the accrual versus cash adjustments, you actually see people with taxable income when they thought they were going to have a loss. And that's a real gut punch when you've already had a bad year. The financials are not good, the bank's not happy, and now all of a sudden you have a tax hit. So really, we recommend as we get into budgeting season here to go ahead and include a cash basis or a tax basis kind of model in the, say, monthly financials as you're pulling those together. And remember to incorporate all of Jim's comments on PPP funds into that. Right now, as the law stands, that is essentially, whether you call it phantom income, you call it taxable income, you call it loan forgiveness income, you may have your book saying, hey, we've got $100 of profit and we had a $50 PPP loan. That may end up looking like $150 of profit by the end of the year when we get to the tax reporting. So those are all sort of points that come back to this year more than other years. We need to be looking at not only what the financials say on a monthly basis, but what the tax looks like on a monthly and quarterly basis. Additional pitfalls to look out for are basis issues. Again, oftentimes owners will take distributions early in 2020 to pay off their 2019 tax. That's fine, but if 2020 ends up being not a great year, we've taken out distributions to pay off tax from 2019, which was a good year. We've got to go into our line of credit to pay off some deductions or pay some liabilities or make payroll at the end of the year. You could end up in a situation where you have basis problems, and that can generate or look like two different things. Number one, if we have distributions in excess of basis, we can actually have capital gain income on our distributions, which is not fun. Conversely, again, if we have a loss scenario, we can have a scenario where we don't have sufficient at-risk basis, and you say, hey, James, I've got a loss. That's great, but we're not able to use it for tax purposes. So we actually end up with needing to pay tax because we're not able to use the loss due to at-risk basis. And the last sort of thought process is, if 19 was a great year and 20 is a less good year, did we have any non-repeating items? Did we make any large depreciation purchases that we normally do at the end of each year, like we talked about, that we're not going to do for 2020? We need to build that into a model that says, hey, what do I actually think tax is going to look like for the year? To complicate each of those things, as Jim mentioned, if we look at a slide about Maryland decoupling, a lot of the federal provisions that are intended to be business owner friendly may not be followed or may not be followed in all years by the state. So we talked about decoupling a few minutes ago. What does decoupling mean? It's when the state doesn't agree to use the federal tax methodology. The easiest one to think about here is when we say, hey, the federal government allows us faster depreciation. Let's say I buy a $100,000 vehicle and I depreciate the whole $100,000. Vehicle's a bad example. A piece of equipment for $100,000, and I'm allowed that entire $100,000 of depreciation. The state doesn't allow that much. It ends up looking like phantom income at the state level. The CARES Act included a number of provisions which allowed us more flexibility for federal purposes. So that was carrying back net operating losses generated in 18 and 19. Business interest expenses were limited by in TCJA, and that has been adjusted to be more taxpayer friendly. Again, business loss deductions that were limited by TCJA were adjusted by the federal government, and the federal government allowed had a sort of drafting error that they cleared up for bonus depreciation and for a 15-year depreciable life for improvement property, qualified improvement property. Each of these is to some degree followed by the state, but oftentimes, as you'll see on this slide, maybe it only applies to 2018 and 2019, and it doesn't apply to losses or impacts in 2020. So all that to say, there's a lot of planning that needs to go into the end of 2020 and a lot of uncertainty. And so staying out in front of it, and while we want to still always think about our normal blocking and tackling rules, we also need to consider whether or not those will work in 2020 and whether or not those are the best course of action. So a little bit more complex analysis this year than maybe in other years. So I think we have a polling question here. And so we say, hey, we've spent a lot of time talking about different planning techniques, and a lot of that is having to do with basis of accounting. Do I know on which basis my entity is accounted for. Is it cash? Is it accrual? Is it I don't know? I have more than one entity. Maybe there should be another box for I don't need no stinking entity. I don't have an entity. But let's take another maybe 20 or 30 seconds and see what we come up with here.
James,
Jim.
while we're waiting for people to answer, here they come. I wanted to give out answer a quick question if I could. Someone asked a good question about the pass-through entity election. And their question was, would the partnership or S Corp receive a deduction for the taxes paid, but then there would be an addition modification for Maryland? And the answer to that is yes. The purpose of this law is to let the business deduct the taxes, not the owners. However, the way the law is constructed, it is net neutral to Maryland. So what happens is if you deducted $10,000 of Maryland taxes in the partnership or the S corporation, you will have an addition modification that gets added back such that you're not deducting any Maryland taxes on a Maryland return, which is the way things are today. Thanks.
Super. Thanks, Jim. Thanks for the question. Very insightful question. And I think as we saw in our polling question there, a lot of folks are on a cash basis. So all of those sort of cash basis concepts are ones that we should maybe think about in this tricky year. Steve, tell us some more about that qualified improvement property.
Thanks, James. So one of the most welcome components of the CARES Act was a technical correction to the definition of qualified improvement property. The need for this correction has been lingering for about 2 years. The qualified improvement property, or what we call QIP, was created under the PATH Act, and it applies to certain commercial property placed in service beginning in 2016. The Tax Cut and Jobs Act, which was quickly signed into law in December of 17, they combined 3 specific categories of qualified property: qualified leasehold improvement property, qualified restaurant property, and qualified retail property. All those were combined into one category, qualified improvement property, which is great. Congress made things easier. Wrong. There was a glitch. So that glitch was, in their haste to pass the bill, this property was supposed to be 15-year property. Instead, they assigned a life of 39 years to it. So this is important because it does not qualify for bonus depreciation. Bonus depreciation is allowed for assets with class lives of 20 years or less. And everybody knew that this was an error. You know, Congress knew it was an error. This was not the intended purpose of this feature, which was broadly talked about before the bill passed. The IRS even came out and said, hey, we know this was a glitch. We know it's not what was supposed to happen, but guess what? It's the law and we can't change it. It's going to take some legislation to change this. So the CARES Act did make this change, and they corrected the glitch and made qualified improvement property, 15-year property, retroactive to assets placed in service after 12/31/17. So what's qualified improvement exactly? What is qualified improvement property exactly? So it's any improvement to a non-residential building's interior made by the taxpayer. It can't be an enlargement to the building. It's not for elevators or escalators, and it can't be a change to the structural framework of the internal parts of the building. So some things to note, it's 39-year property. So if you've got an asset, it's 27 years property, then that means it's residential property, and this will not qualify. So we're only looking at property assets that have a life of 13-year property. It's made by the taxpayer. They added this language. That doesn't mean that the owner has to go out there with a hammer and saw and make these improvements. It just means that you can't buy a building that had qualified improvement property done to it last year and then deduct that portion of the improvements. It has to be originally with the taxpayer in order to be deducted as qualified improvement property. There's the taxpayer's got to look at the assets particularly. You've got interior versus exterior. This may be an easy process. You may have HVAC. You've got the ductwork inside the building. That's qualified improvement property. The unit on top of the building, that's outside the building, so that's not QIP. So that's easy, but maybe it's something larger. Maybe you've got a large construction project that you can't easily look at and break out what's QIP. In that case, you may want to engage a professional to perform what we call a cost segregation study, which we can do. SC&H has a great department that does this. They can look at your improvements and determine which life should be assigned to it and whether or not we can take this deduction for qualified improvement property under the bonus rules. So now that they've fixed this problem, taxpayers now have the option to go back to 2018 and recover deductions related to the reclassification of these assets, which can now be fully expensed under bonus depreciation rules for federal tax purposes. As James alluded to, there is a decouple on Maryland side, so you'll get a deduction for federal, but not for Maryland. And in the next slide, we'll talk about the options we have. So because QIP, and can we slide to the next slide? No, I'm sorry, back again. Sorry about that. So because QIP correction could cover several years beginning with 2018, there's several options to consider. First, the taxpayer entity. And when I say taxpayer, I'm talking about the entity that owns the property. They can do a catch-up using a Form 3115. And this would be a change in accounting method that you would do on your tax return. We call this a catch-up because the form basically says we're changing the way we're treating this issue, and the cumulative effect of this change is income or income or expense equal to X amount. And therefore, we're going to report this additional expense or income on our tax return. So we do this cumulative adjustment catch up on the Form 3115. Now, this option is done as part of the tax return, so it's not done with the year in which the change occurred. So you can actually do this catch up in 2020 on your 2020 return and catch yourself up. So you're not actually doing it in 2018 when the adjustment occurred. Secondly, you can amend the tax return for the entity which owns the property. You can amend 2018 or 2019 or both. Bonus depreciation is automatic. So if the taxpayer needed to elect out of bonus each year when they file their tax return. So maybe the taxpayer elected out of bonus before they made this change, and now all of a sudden we want to take bonus. Well, the IRS came out with another Rev Proc that said you can revoke that election. So that's not an issue. There's an administrative cost to amending, since it will require an amendment at the owner level if we're talking about an S corporation or partnership that's doing the actual amending. The benefit is that it allows you and your tax preparer to decide what year would be more beneficial to take the advantage of the additional expense. Do we want to amend 2018 and take the deduction in 2018, or do we want to do a 3115 and take the deduction in 2019 or 2020? There is a limited window for amending partnership returns, which are subject to the Bipartisan Budget Act of 2015. These partnerships must act by September 29th of 2020 to amend, or otherwise they face a more complicated process that may not generate a deduction in the year of choice. So in the next slide, I'll talk about this specific issue related to amending partnership returns. So let's go back and say, so why do we have two types of partnerships? So the Bipartisan Budget Act of 2015 sneaked in a change to the way partnerships are adjusted, either by the way the IRS does an audit or by way of a change generated by the taxpayer via an amended return. These new BBA rules apply to all partnerships, but allowed some partnerships to elect out of the rules each year. So if you see an election on your partnership return for 2018 or 2019 that indicates you are electing out of the centralized audit regime, then you know your partnership is a non-BBA partnership. So amending a non-BBA partnership is easy. I mean, if you could use that term when you're talking about partnership taxation, you simply file a Form 1065X to make the change, and then the partners will file amended returns to report their change that's reported on their amended K1. So if you have a BBA partnership, they can't amend their returns. They have to follow a certain complicated process that the partnership has to catch up. They have to file a catch-up adjustment. This process just rolled out back in December. Like I say, it's pretty complicated, and the catch-up is in the year that the partner receives the form indicating that they are amending their return. So the partner may not get this form until 2020, in which case they will report that on their 2020 tax return, or they get it in 2019 and they report on their 2019 tax return. So the purpose of the CARES Act was to provide relief quickly to Americans during the pandemic. And the IRS recognized that the BBA process was very complicated, and it's not going to put money into the hands of taxpayers very quickly. So they came up with this RevProc 2020-23, which will allow all partnerships, BBA or non-BBA, to file a 1065X. Now, the BBA partnerships, they only have a window of following this 1065X up until September 29th of 2020. So you literally have 2 months to file this return. Otherwise, you've got to go into this long process under the BBA. And also, it's important to point out that the use of this exception is not confined to QIP. So if you have any other reason why you have to amend your partnership return and you are a BBA partnership, then you can file a 1065X up until September 29th, 2020. So that brings us to our next polling question, which is, I believe I have fixed assets that meet the definition of QIP, which I have not fully deducted. So take a couple seconds to answer that question, and I think we are going to open it up to questions across the board here for business tax. And do we have an answer? So in this respect, 67 people have said, no, I do not have QIP. 15%, they don't know if they've got QIP or not. So of those 15% of people, I'm glad to have a conversation with you so we could help you decide what you need to do before September 29th.
Thanks, Steve. We're going to get right to Michael in the interest of time to let him get through his presentation.
Thanks, Steve and Jim. So down to the wire here, I think what we're going to do is open up with a polling question that we've got, and we can run through this fairly quickly. Is your company expecting to generate a net operating loss in your 2020 tax year? That'll be the last polling question of the session. Okay, so do we have the responses up? Okay, that's interesting to see, because actually one of the things that we're kicking off with from a corporate tax perspective, and one of the things we're seeing is that 2020 is really expected to be a tough year for many businesses. The thought process is carrying back an NOL, net operating loss, from 2020 to recover corporate taxes that were paid in connection with the previous year's tax return. That's not going to occur until 2021. So one of the ways that Treasury designed the CARES Act to help put cash back into taxpayers' hands now is allowing losses that are generated or that were generated in 2018 and 2019 tax years to be carried back in an expedited fashion, which is what you see up there, the Form 1139, which helps you do that and recover taxes within an expectation of 90 days. Some of the other things that are beneficial in terms of the CARES Act to corporate losses that took place during these essentially 3 tax years, 18, 19, and 20, is the 5-year carryback rule, which is a welcome change that was previously disallowed as part of the Tax Cuts and Jobs Act in December 2017. The removal of the 80% NOL limitation, this is temporarily, that was also part of the Tax Cuts and Jobs Act. And as we just referenced, the allowance to file Form 1139, which is the quick refund form essentially. This has been really helpful to many of our clients that we've seen come through carrying back losses from 2018 in particular. It's sort of as soon as the act was passed, you know, we had clients that had losses previously in 2018 that were intended for other things, future taxable income and offset to future taxable income, that were all of a sudden available to carry back and recover taxes going back as far as 2013. That received a lot of attention. There were expedited ways to file this form, faxing it into the IRS, and some other nuance that was available at that time. So that's been a big benefit. One of the sticky issues that came out of this that we noticed is AMT. That became a consequence of carrying back these losses. AMT, the alternative minimum tax, was actually repealed as part of the Tax Cuts and Jobs Act. And so a loss that was generated in 2018 doesn't have an associated alternative minimum tax loss with it. While tax back in 2013, or a tax return filed back in 2013, was subject to AMT. So when carrying back this loss from 2018 to 2013, there's a bit of a complication, because the rules that we are being told is that the alternative minimum loss being carried back from 2018 to an earlier tax year when there was an AMT regime should be treated as zero, which actually runs counter to current enacted authoritative guidance. I would expect to see further discussion about this, but until then, because of uncertain guidance, what we're going to do, what we would expect to do, is any AMT that's generated by carrying back a loss from a 2018 year or 2019 year or 20 year to a previous year that has AMT and gives rise to AMT tax, what we would do is carry that forward and claim that as a refund on the next filed tax return. Couple other quick things to mention is when a net operating loss is generated, when it's carried back from a 2018, 19, 20 year to an earlier tax year, just be mindful of the impact that that's going to have on other items unique to corporate taxation, the former Section 199 deduction, any foreign tax credit utilization, Section 965 installment amounts, FDII, GILTI, and if you're that size, BEAT computations. Quickly, there is a new, rather important rule that came up regarding consolidated groups. There's a consolidated group split waiver election, which allows an acquiring consolidated group to access its own carryback tax years while simultaneously preventing a carryback to taxpayer years of the new member, which would generate a refund payable to the original consolidated group. So consolidated group buys a member, and we can leave that slide. Consolidated group acquires a member. That member that was acquired has its own operating losses that really could belong to the previous member group if forced to carry back it would go to the original member group. This split waiver election allows the consolidated group to preserve that NOL for itself rather than hand it back to the former group that sold. From a state tax conformity perspective, with respect to NOLs, we can see DC, no carryback, Delaware 5 years, Maryland 5 years, and Virginia, none. Some of the other changes, we can drop to the next slide, please. Okay, some of the other changes that we saw impacting corporate taxes. The 163J business interest limitation was increased from 30 to 50%. Let's just be mindful that that can give rise to an NOL in 2019 or 2020. If that's carried back against pre-2018 taxable income, a tax benefit is recorded for financial reporting purposes. A special election is available to use 2019 adjusted taxable income for purposes of the 2020 163J business interest limitation. For companies who are scheduling, and this is really geared towards accounting for income taxes and your financial statements, scheduling out your deferred tax liabilities and assets when you're looking at evaluation allowance. The provisions of the CARES Act should be carefully considered. You're going to have fewer NOLs, likely a smaller 163J deferred tax asset, which puts you in a better position as far as evaluation allowance is concerned. The benefit of any of these provisions is going to be recorded as a windfall benefit in the financial statements, thinking about the fact that we're recovering taxes at a higher rate in a previous year when you're carrying back an NOL from a lower tax year to an earlier tax year. Carryover AMT credits should be classified as currently receivable. And finally, on our last slide, we've seen many of our clients take advantage of is the opportunity to defer the employer portion of payroll taxes. Of note, 50% due by the end of 2021. The other 50% is due by the end of 2022. Last note of interest is the CARES Act initially suggested that employers who benefit from the PPP could not defer payment of Social Security taxes, and then they said they would be eligible to defer payment, but as soon as the employer is notified the loan's forgiven, the employer would no longer be able to defer payroll taxes. But finally, last month, guidance was updated again, which removed that limitation of federal payroll tax deferral for employers that had a PPP loan forgiven, so that deferral of payroll is available to all taxpayers, even if and when the PP loan is forgiven. So that wraps up the corporate section. Greg, back over to you.
Thanks, Michael. Thanks for all the presenters. Sorry, folks, we ran over just a couple of minutes. There is one question that was submitted addressed to Amanda's presentation around trusts and estate planning. The question, it's relatively significant but quick answer. The question was, if you're moving to another state, would that change a trust that was set up? And the answer, I'll take it, Amanda. I think that the answer there is the benefits of the estate planning through the trusts that Amanda talked about should be available from, and we think are timely and should be pursued likely in the near term if you want to take advantage of the environment, the interest rate and asset value environment. The state in which you move to could, which state that is that you move to could have an impact on longer term planning results, but it should not eliminate the planning opportunity. So my advice there would be to make sure that you check in with your tax advisor and consider future physical moves in that planning. And actually, it could result in additional opportunities that could impact on that planning. So with that, we're going to wrap up. I'm going to thank all of our presenters, all of our attendees. Remind you to stay in touch both with your SC&H advisor and keep an eye on the COVID Resource Center on our website. Thanks, everyone. Hope you have a great remainder of your week, and we look forward to being in touch. Thank you.